let's go ahead and get started. I've got a lot of great information. We've had some great news on the investor return this month. As many of you saw in the email announcement yesterday, we put another record-setting return for our investors, and I anticipate that to be to occur here over the next couple of months as we're bringing more and more loans that are paying a much higher return into the portfolio, and as the legacy loans that pay a slightly lower yield are paid off. So let's go ahead and get started. Just as I get started, feel free to use the Q&A button, both at the top for some or at the bottom for others, to ask questions. Again, if there's a question that you have, there most likely is another investor that is going to have that same question, and feel free to lob those questions in at any time. It gives me a better idea of kind of the content that you're interested in learning about. So today we're going to talk about the November numbers I just posted. As I had mentioned, the numbers came in great, came definitely in higher than last month, and again, the highest return we've had for the fund thus far. The participants in the call today are going to be investors that are currently invested in the fund and people that have interest in the fund as well. All right. So let's start off with some of the notable successes. As I mentioned, the fund returned, and it's actually an 8.17% annualized return in November. And I'll go into why we saw a significant increase in the return to the investors, but pretty much because now we're bringing in higher yielding loans into the fund. Bullet point number 2, we have no late payments or loan defaults, and that's great. Our servicing team is working well to ensure that payments are coming in on time, and those loans that we anticipate maybe a late payment or any issues, we're taking corrective action immediately. Our investor relations team has been working overtime as well. We raised about $7 million over the last 30 days. And obviously our $500 credit promo worked very well. And we paid out over $14,000 in promotional credits to our investors. So congratulations for those that took advantage of that opportunity. We'll definitely be running that type of promotion sometime next year. I don't know when, but we'll definitely be sending out that promotion. We did surpass 30 million in total investor commitments, and that was one of our big goals, or actually our stretch goal for 2022. Imagine about mid-December, we were kind of floating around 23 to 24 million. And we raised that 7 million in 30 days, and now we're going to jump over 30 million. And again, I keep saying, why is that 30 million mark such an important number to get above? And that's when you start to see the administration costs as a percentage of total investor capital start to decline. So as you get more and more money in the fund, your cost to physically administer the fund start to become static, and then a smaller percentage of the overall assets under management. And that's why 30 million is a big number. And then the other item is that we returned over 150,000 in investor dollars to our investors in November. Thus far, we have returned over 1.54 million year to date, and that'll be above 1.6 million as we close out the year. So congratulations. We've had a great success thus far in the fund, and I see a lot more successes coming down the pike here shortly. So let's go into the origination numbers. Now, origination for November were down significantly, and we anticipated that. Both October and November really were not great months in terms of new loan origination. And the reason being is that we saw a significant increase in rates. And so a lot of our borrowers did, two things occurred. Number one, a lot of our repeat borrowers that were buying fix and flips really held. They weren't buying any new properties. They were concerned about where rates were. They were concerned about where the market was going. So we really didn't see a lot of new loan requests coming through. Now that changed in the beginning of November. Now consider that it's about a 30-day lag period between the time you get an actual loan request to when you physically fund that loan. So anything that we got in November is funding about this time frame, and that's why we've seen a significant increase in the number of loans we'll be funding. In fact, I think we're tracking right now probably about 7 to 9 loans, a little over 7 million. So compare that for November, where we had simply 2 loans, and we funded 1.39 million. Now, this is just for the mortgage fund. As many of you are aware, we do offer a 30-year rental loan that some of our investors take advantage of, but this is specific to what is going into the mortgage fund. So November actually was a great period of time where we can kind of take a step back, work on some efficiencies within how we originate loans, how we underwrite loans, how we close those loans, and then obviously working with investor relations as well has been very busy with our promo. So we were able to kind of shift some of our attention into raising more capital for the fund. Right now, the loans that we funded for November had an average return to the fund of 9.25%. So you can tell when you're putting loans at 9.25%, but your weighted average coupon or the average interest rate of the fund is slightly above 8%, how quickly it's going to start to increase, or the return of the fund will start to increase. Average loan to value of the 2 loans that we put in, 70% loan to value. I think the 2 loans were 2 fix and flip loans. So yeah, we were at 70% loan to value. Average duration of the loans were 12 months. I love 12-month loans. You don't take a lot of, you can really reduce your risk or interest rate risk by doing shorter term loans. So if you get caught in a longer term loan, a loan that maybe is 24 or 36 months, and you've got a fixed interest rate on it, you may be under the market for the rate that you should be earning on the loan if it's a longer duration loan. So you want to try to keep them short term. The other thing we've been playing with, if the borrower is looking for a longer term loan, so 24 or 36 months, you can actually build in a fee structure, or essentially a loan that's going to fluctuate in rate, maybe reset every 12 months. Similar to maybe what you would call like an adjustable rate. And I hate to use that term, but an adjustable rate hard money loan. So every year at the 12-month mark, it may readjust to where rates are at that point. And then both loans are first position loans. So you're really not going to see many second position loans in the fund, if any, maybe 1 or 2 if there's the right loan, but really we're not going to be putting seconds in the fund. So let's take a look at the types of loans that we funded. As I mentioned, they were 2 loans, so 2 fix and flip loans. For those that aren't familiar with what a fix and flip loan is, fix and flip loan simply is the borrower is purchasing a single family home, multifamily, or commercial property with the intention of renovating it, and the exit is a future sale. So TaliMar Financial, I've done almost 800 of these types of loans. I like them because the borrower is coming in with the intention of adding value to the property, and there's a clear exit strategy to the loan. The downside to fix and flip loans, as I continue to mention, is that the duration of the loans are typically shorter term. So I think the average fix and flip loan, the actual duration of it is around 6 months. So you're constantly shuffling in and out of fix and flip loans, versus kind of a bridge loan where there's no real value add component to it. Borrower just needs to purchase that property, or they have to refinance an existing loan. I did some data analytics, and I think the average duration those loans are outstanding is a little under 12 months, about 11. I think it's like 11 and a half months. So they're what we call stickier loans. They're on the portfolio longer. And if you've got a lot of capital and you're trying to get it out, you typically want to see kind of stickier loans, so you're not constantly having to put new loans in as old loans pay off. No construction loans. We're really not focused on construction loans right now. I'm still concerned about new construction simply because costs continue to rise. A lot of these loans that were funded early this year, late last year, are having trouble on cost overruns, and the lenders having to come back and contribute more capital to the project to get it done. And then when you start to have volatility in values of real estate, you can really get caught on these new construction loans. Loan servicing. So right now we have 45 loans in the portfolio, so 45 active loans, with a total outstanding balance of about 24.5 million. As I mentioned, we've got about 7 million that we're going to be closing. So we should be jumping above 30 million here shortly in total loans outstanding, or total balance outstanding. Average loan to value over the entire portfolio is slightly above 65%, trying to keep it at that 65% level. Average duration or term of the loans right now are at 15 months. And interest income right now is we're paying out around $170,000 a month on interest income earned by investors. Average interest rate. So, and now these numbers reflect as of today. Okay, so they're not showing as of end of November, but they're showing what the returns are today. So average rate of the portfolio right now is at 8.371%. Loans in default, none. So we've got no loans in default and no late payments. I'm going to take a quick sec here. I got something's beeping here. Okay, I think we're good. All right, loan portfolio. So right now in the entire loan portfolio for the mortgage fund, about 60% of the loans are bridge loans. And so again, these are no value add component to it. They're just based on current value. Borrowers just simply making monthly payments. Usually the exit strategy is a refinance with more conventional financing. 25% of the loans or 26% of the loans in the portfolio are fix and flip loans. Again, borrowers going in intending to renovate the property. They're shorter term by nature. And then 13 or about 14% are roughly fix and hold loans. Those fix and hold loans, same idea, but they're actually, the exit strategy is a refinance. So let's look at the loan portfolio by property type. So again, we're very weighted towards SFR 1 to 4 units. I like that product type. If there is volatility in the market, SFRs typically hold value out of any real estate type the best because people always need a place to live. And so we're always going to be really weighted and focused towards the SFR property type. And then the remaining 30% are going to be in commercial. Commercial is a pretty big scope of property types that could include office, industrial, and other types of properties. So as the fund grows, we're going to have to be funding these types of loans because they're typically larger loans. And in order to move the amount of capital that we will have in the fund, you're going to have to be looking at larger loans to fund. Okay. So in the mortgage fund right now, we have 26 million in active capital, and we have another 4 million that is been pledged to the fund. So that 4 million is going to be coming in over the next week or two. We have 116 total active accounts, and of the 116, I think we calculated about 23 or 24 are multiple accounts. So one investor may be investing out of their non-retirement funds, and then they also have active accounts for their various retirement funds. So if anyone's interested in utilizing their self-directed IRA or utilizing a self-directed IRA to invest in the fund and they don't already have one set up, feel free to reach out to me. We do have a preferred vendor that can help you create a self-directed IRA and utilize those funds to invest in the fund. For those that are not familiar with what a self-directed IRA is, definitely go to our YouTube channel. We did a great interview with Brian Davis of AccuPlan, talking about the basics of investing with a self-directed IRA. So go ahead and check that out. And then also those that missed out on our interview with Gabe Candia of Perch Wealth to talk about 1031 exchanges and the Delaware Statutory Trust. I think we just loaded the video, if I'm correct, just loaded the video on the YouTube side. So I'll go ahead and send an email out with a link to that video. It's great content for those interested in the 1031 exchange and a Delaware Statutory Trust. Right now, our net yield to the investor is at 8.238%. So as I mentioned that we earned a net yield last month of 8.17%, but as we bring in new loans, that yield will go up. And so I anticipate that we're going to be in around that 8.238% range for December. Interest net income to the investor right now is at 161,000. And our expense ratio, now this is the ratio between what the actual gross return, so all the interest income that's earned by the mortgage fund, there is a cost associated with running the fund. And these are not fees that go to TaliMar Financial, but our third-party vendors. So like Verivest doing the fund administration, money set aside for the annual audit, accounting fees, and other various fees. So the expense ratio, when you combine all of that together and compare it against the outstanding, the gross yield of the fund is about 0.481%. As I mentioned, we're trying to drive that down to about 0.25%. So as the fund grows, that expense ratio will drop. So let's talk about market update. I'm seeing rates settling right now between the 10 and 10.5 range for hard money. I know the Fed increased rates again by about another 0.5 point, but this is kind of where the competition is right now for first trust deeds in the Southern California market. I know before a lot of people comment and say, well, I'm getting 12% or 14%. This is for the Southern California market. There are markets that have more risk. You get your Midwest markets or Northeast markets that might be earning a little higher of a yield. But this is really specific to the Southern California market in first position loans. Number of homes listed on the market continues to drop. We were really concerned early in this year that you're going to see a significant increase on the number of homes that were going to be on the market because the anticipated slowdown in the market due to the rise in interest rates, and you're just not seeing it. We saw that peak, that 30% increase in value, especially here in San Diego, since about this time last year, and that's definitely pulled back. And I would say prices are probably down around 10% from the peak, but that still puts us around that 15 to 20% annualized increase in values in real estate, especially here in San Diego. This is not to say that you're not seeing a decrease or an increase in days on market. You definitely are, but buyers and sellers are finding ways of moving real estate. I think the media has been really talking about the ability to buy down rates. So, borrowers are definitely out there able to get a 5.5% interest rate. For those people that have owned homes for a while, 5.5% is not that bad of a rate to have. So I think the concern of where the market was going earlier in this year may have jumped the gun on that, but we continue to watch where the market is. And we're comparing as our fix and flip loans pay off, constantly comparing to what we underwrote to what the actual sales price is. And this is why it's really important if you invest in trust deeds or if you invest in a mortgage fund, really stay focused on properties in core markets. When you start to get out of core markets, so secondary, tertiary markets that really rely on second homes or investment or investment properties and whatnot, you're probably going to see those get hit the most because when there's volatility in the market, people don't go out and buy second homes. They're maybe not buying investment properties. So, but they will be buying homes in core markets like San Diego, Orange County, LA, and the Bay Area. Rents have stabilized. I did have, I was at a conference last week where they had some local multifamily developers, owners, and operators on a panel talking about where rents were going. And you're actually starting to see rents really stabilize. And some of the bigger owners of multifamily properties have started to give away 3 or 6 month rental incentives to tenants to coming in. Now, it's really hard to say, do they really need to give the incentives away? Or are they trying to hold prices? So when you own multifamily properties, you don't want to have charged half your tenants at one higher price and then having to lower it significantly to new tenants coming in. Usually you have loan covenants and whatnot that restrict you from doing that. So you can go ahead and give away incentives to keep up that rent, the monthly rent amount. So right now it's hard to tell if rents are really coming down, or they're willing to give incentives away just to get their units leased up. And the other big thing is we've seen loan requests tripled since early November. So I mentioned that we really saw a slowdown in October and early November. Seems to have picked right back up to where we were earlier this year. We have a lot of loan volume coming in. So we have a lot of available space for new investor capital to get invested. So discussion points I want to cover. For those people in the Bay Area, I am going to be up in the Bay Area next week, and I have an informal holiday event scheduled in Walnut Creek. That's December 28th from 6 to 8 p.m. at the Bounty Hunter Wine Bar. If you're in the Bay Area and you want to come on in and talk to me, I'd love to see you there. Again, 6 to 8. I'll go ahead and send another email out with an RSVP with the directions to get there, but I'd love to see you there. Investor distributions will be deposited today or tomorrow. It'll be dependent upon how quickly your bank accepts those funds. So those that take monthly distributions, they'll be deposited. Those that reinvest their funds, they've already been added to your account, and you'll be compounding that income going into next month. Monthly statements should be posted by tomorrow, and you can find them now at this website. So invest.talimarfinancial.com. I know there's some confusion. Verivest is the fund administrator for the fund. And so they do the accounting, and they're the ones that post all the monthly statements. That's why the statements are posted on their site. We don't have the capability yet to post it on our lender portal. So if you want to get the physical statement, go get it. It's at invest.talimarfinancial.com, but a link to that will be emailed out to you shortly. Please keep in mind, we had a lot of investors found the email that went out with a link to the statement went into their junk folder. So keep an eye out in your junk folder. If you do see it go in the junk folder, depending upon what platform you use to get your email, go ahead and you can select usually a settings that will stop it from ever going into the junk folder in the future. Also, look for the TaliMar Financial emails in your junk folder as well. Go ahead and again, do the same thing, make it a safe sender or recipient so that you can always be up to date on the emails that we send. So rolling out our 2023 goal, end of year is going to be 75 million raised for the fund. 75 million is a good number that we feel confident that we can continue to get out on a consistent basis in the San Diego market. That's why I set it at 75 million. Currently, we're at 30 million. So it isn't a far stretch to get to 75 million by end of year next year. We're actively looking to bring new investors in. So if you invest out of non-retirement funds and you want to consider putting some retirement funds in there, we can help you create your self-directed IRA and get those funds active in the fund. As I mentioned, if you're interested in investing in the retirement funds, I'll go ahead and make an introduction to Brian Davis at AccuPlan to set up that account. So a couple of common questions that we're getting. Number one, when are the end of year K1s? So remember, you're not going to get 1099s, you're going to get K1s, and those will be distributed hopefully by late February, if not by early March. A couple other people are interested in changing how they get their distributions. If you're interested in reinvesting your distributions, just go ahead and contact me or my investor relations team, and we'll go ahead and do that for you. So we'll change you from taking your monthly distributions to simply reinvesting the distributions. Again, one of the benefits of reinvesting is that you get to compound that income. If you have a self-directed IRA and you're getting deposited $1,000 or $2,000 a month, but it just sits there not earning any income, you may want to consider just reinvesting those proceeds. And when you need to make a withdrawal in the future, you can go ahead and do that. Retirement funds can be invested in the mortgage fund. So we do not have a cap on the amount of retirement funds we can accept for our mortgage fund. There is no income cap to qualify for the 20% tax deduction. I know that's been a very popular question, is when you do read some of the sub requirements for what we call a qualified business income tax deduction, or QBIT, there is an income gap. But because we've structured it as a REIT, that supersedes any income cap that QBIT has. If you want to reinvest, the minimum reinvestment is $1,000. So if you're looking to reinvest a smaller portion, it doesn't have to be that minimum 50,000. You can reinvest as small as $1,000. And then lastly, again, there is no lockup period for investments. Okay, so we've waived that 12-month lockup period. So if you're interested in investing in the fund for a shorter duration, or you just kind of want to see if it's something you want to be involved in longer term, feel free to pledge your investment and get a feel for how it works. I did draft an email that went out a couple of days ago. There was an interesting article in the Wall Street Journal talking about deposit on checking and savings rates. And they were mentioning that the national average right now is around like 0.2% on the income generated, the interest earned on deposit accounts from the top 5 banks, which was surprising to me in one way, but in the other, it's not surprising because I knew they weren't going to raise interest rates on any of their accounts, even though they were raising rates on the loans that they were putting out. So you should see a significantly higher spread on income for banks that they're making, because they're just not paying their depositors, they're just charging their borrowers a higher rate. So that was interesting. If you're interested in getting a copy of that article, a link to that article, I'll be more than happy to share that with you. So I just want to end this with happy holidays. My team is still working hard right now, closing out the year, but we want to wish you and your family a happy holidays. And those who jumped on today, thank you for taking part. I know this season, about this time, it gets busy with travel. So thank you for listening. If you weren't able to listen to the entire webinar, I'll go ahead and post a recorded version of it here in the next couple of days, and I'll send another email out to a link for that. With that, that is the end of our presentation. I didn't get too many questions today. Maybe I just did a great job of explaining everything, but if you do have any questions, feel free to submit a question through the Q&A tab. If you are not invested in the fund and you're interested in getting a copy of the executive summary, I put a little QR code here. You can actually use your phone, turn the camera on, and then focus the camera on that QR code, and it'll allow you to download the executive summary on your phone. So while you're traveling and you need some really exciting reading, you can look at our executive summary. I did update it, so all the numbers in the executive summary are good through Q3 of 2022. I will be here in the office all week. If you got any questions about the mortgage fund, or if you've got want to invest any more funds into it, feel free to reach out to me or go to our website and go ahead and submit your pledge under the investor tab. And then one last thing I forgot to mention earlier on is that yes, we have stopped the legacy platform of investing in trust deeds. We shut that down. It was a great platform for us over the last 10+ years. Unfortunately, just with where the growth of the company is going and the large amount of capital coming into the mortgage fund, we decided that this would be probably the best time to put that one to bed. So thank you for those that have been investing in trust deeds through TaliMar Financial. We really appreciate it. And we hope that you come over to the mortgage fund. We think it's a great option to invest in. So with that, again, I want to say, wish you and your family a happy holiday. Thank you for listening in. And for many, I will connect with you in January. And lastly, if you are in the Bay Area and you do have time to come on down to the Bounty Hunter, please come on down. I'd love to see you. Thank you very much.